up? What's up? What's up? What's up? Hello, people of the interwebs. Whoever's out there, hello. I'm gonna pull myself up just gonna create a little view here so I could see myself, so I could see what the chat is all about. Ooh, we don't want that. All right, so right now we only have Lion of the Chain. What's up, Lion? It's good to see you. Are we all good? Can you guys hear me? Yeah? Awesome. Okay, cool. So I am back on this live today. It is Gaven is still in Russia and he's super busy with his family, so he needed me to kind of step in. So I know that we talked about my last live being a week ago, but actually you'll probably see me this week and next week. And greetings. What's up, Mass Destiny? We got V Brewer, Amari, Jordan, our helper. And yeah, guys, I'm excited to talk with y'all today. I'm gonna kind of do a little bit of twofold things with you. I'm gonna show you the good and what we can expect, and I'm gonna paint the bullish side of things, and then I'm gonna paint the bearish side of things as well. But I think before we get started, it would be Lease Dollar. Wow, I have not seen Lease I have not seen that name in a second. What's up, Lise? Really good to see you. I think we spoke on the phone originally. She's one of our ARC students. Sorry, I get distracted when I see familiar names. But essentially, I just kind of want to talk about first, before I break anything down, the importance of being able to pivot or take information and act on it, right? Because essentially, actually, let me get this thing out of here. It's all delayed and I don't want that. Essentially, new information pops up sometimes and we have to act on it, right? So I'm gonna show you guys some news that's not so good for the market, and I'm gonna show you guys some news that is really good for the market, right? And it's always a balance of probabilities, right? Exciting news pops up and the market gets excited and it buys more assets. And then sometimes scary news pops up, right? And one thing I forgot to pull up that I'll pull up here in a second. So one thing happened about a week ago, and we essentially saw that the U.S. economy is a lot weaker than it was expected. There were a lot of There were a lot of jobs that we thought were added to the economy back in April and May and at the beginning of the year. And the Bureau of Labor Statistics, who is, they do these surveys to people and businesses, like, hey, how many jobs were added or whatnot. And there was a really good video that Andre Jick, who is a pretty good YouTuber, made on this, where they talked about these revisions that happened. If you guys are keeping up with the news, you might have seen it. And essentially what happened was we thought we had added over 200,000 jobs in April and May of this year to the economy, right? And so the economy looked good, all right? And what happened a week ago was not only did we not get great jobs numbers, we got these revisions that came in, and these revisions basically said, oh wait, this is not the exact number, so don't hold me to it, but it's essentially, hey, we didn't add 250,000 jobs. We actually added 73,000 jobs, right? So it was way weaker than it was anticipated, and it was something of a bad moment for the market, right? And the market started selling off last Friday. And then some things kind of happened this week that we'll also cover, because it's always good to cover the good along with the maybe bad news. But essentially, the Federal Reserve, who we've covered, interest rates. I did that in one of the live streams that I did. And basically, Jerome Powell, who is the chairman of the Fed, and I'm sure that that's not an easy job to have control over the world and global economy at your fingertips by controlling interest rates, obviously, right? They had a thesis. They said, hey, look, inflation is still at 4%, but the economy is looking to be doing good, right? And so that's the reason why they kept interest rates the way that they have held it, right? Which is higher. And as we covered on the first live stream I did like a month ago, the $1 trillion opportunity, right? Interest rates are super correlated to the performance of a lot of assets, specifically speculative assets. Every asset is speculative on some degree, but I'm talking about like the assets that you can make a bunch of money on with maybe smaller investment, right? The riskier assets. And essentially, just to review, right? When interest rates are high, the risk-free return that the big money can make is a lot more attractive, right? So they don't have to risk money by going out and buying Bitcoin and buying, well, I don't even know if Bitcoin can be considered a crypto. I think it's its own institutional asset now. But why would I buy, Ethereum or Solana when interest rates are I can make 5% per year, by just parking my money at the Fed. So they don't, that's what they do. They choose not to get into risky investments. And then when the Federal Reserve starts dropping rates because they need to stimulate the economy, that's when that money starts to move over into riskier assets, right? And another thing I forgot to pull up here is, so in long term, right, we have like the setup of a decade. This is incredible. I mean, this is going to bring us so many wealth building opportunities. It's not even funny. But let me see. How do I want to organize this? I have a bunch of stuff I want to talk to you guys about. So let's put this after that Fed person. Yes. Okay, cool. Let's do the jobs. Sorry, guys. Hold on. All right. We'll put this before that. I just have like a sequence I want to kind of guide you guys through. And I want to make sure that we do this well. Yeah. That's maybe. So we'll kind of like ebb and flow. Okay, we'll ebb and flow with all of this. And let's just quickly get started on the jobs. Okay. So essentially, right, I'll just point it real quick. Hey, what's up, Gia? See some ARC fam in the group. Can you guys see my screen? You probably see my screen. You probably see my screen of my screen, right? I hope so. Yeah, there it is. Awesome. So here's the article, right? U.S. job growth stalls, just 73,000 jobs added in July with a stunning downward revision to recent months. So this is what kind of pushed the market down. Now, what happened was this released on a Friday, right? And the Federal Reserve has a bunch of data that's released in between their meetings. They meet every, I think, 45 days, right? They have like 8 meetings a year or something. So they meet every 45 days. And basically what happens in these gaps of time is a whole bunch of economic data gets released, like inflation data and economic data. Is the economy expanding or contracting? And that's done through a survey of all the businesses and corporations and industries that they survey, right? And that's that ISM that we look at. And essentially all that data comes out, and that data can be easily tracked on this thing called Forex Factory. And then really all you got to do is, because I love macro. This is what the market always looks at. This is what the market always looks at, right? You could look at this Thursday, August 7th, right? This is not great for the economy, but I'll tell you why the market might actually look at bad news as good news, right? So check this out. So today, what came out, this is unemployment claims. The actual number came in at 226,000 unemployment claims for the month of July. We forecasted only 221,000, right? So the market always is trying to predict what's going to happen. What's the economy doing? Is inflation going to be this? Like, there's always expectations that the market has leading up to these events. And then when the real number comes out, it either beats it, right? It either comes in lower than expectation or higher than expectation or at expectation, right? So what happened was the number, you can see this was released at 7:30. I didn't know these numbers came out, and I was wondering why the market was pumping today, right? And check this out. 226,000 jobs lost, right? Unemployment claims, right? Let's see the trend of unemployment. Well, I guess the trend of unemployment, it's pretty consistent, right? But you could even see from the beginning of January, right? Like unemployment was going up and then it went down and now it's going up. But regardless, this was not what the market was expecting. It was expecting less unemployment claims, right? So the reason why that's good for the market, right? It's so interesting how the world works, and what's good for the economy is bad for the market. What's bad for the economy is actually good for the market, right? And the reason for that is because, well, when we have bad economic conditions, like we kind of are exhibiting right now, what the Fed is going to do then is they're going to lower interest rates, right? Because they want to stimulate the economy. They want to kind of start, pressing on the gas a little more to make the economy run faster than it is, because it's slowing down. So we have to now add more fuel to the fire to make sure that things keep going. What they really care about is the velocity of money, right? Like how quickly are dollars flowing in the system, right? If dollars are flowing at a faster rate, it means that more people are making money, more people are getting paid, more people are spending, more people are traveling, more economic activity. And when that slows down, that then causes a crunch or a contraction, right? Now, these numbers get released every month. We could see what happened yesterday. So you could see the impact of every news. Like really, we care about the red flag events, right? You could see this came out, ISM services PMI came in at 50.1, right? Now, if you guys remember some of my other live streams that I did, the ISM is essentially a gauge on is a certain sector in the economy expanding or contracting, right? And you could see if the number is above 50, it means it's still kind of expanding, right? You could see, like, for example, the COVID lockdowns, right? This is a measure on the services industry. The services industry in May and June took a big hit. And so what happened, those contracted, right? Those sectors contracted. And again, these types of reports come out like almost every week. There's some sort of a report. Here's August 1st, right? This is what caused the big sell-off. You could see the unemployment rate came in at expectations, and it's at 4.2%, right? Which is still above the Fed's target of about like 2%, right? Or really like 3, I guess, because that's where it was. And they look for trends, right? Because you could see from like 2008, right? Unemployment went sky high to the point where in 2010, 10% of people were unemployed, right? But then the Fed did quantitative easing. They stimulated the economy. The whole world reset and dropped interest rates to 0%, right? Free money. Literally, it's free to borrow, or it's very inexpensive to borrow. And then that came with the, hey, buy now, pay later programs and 48 months of 0% financing, right? They just want you to spend money. And if you have debt, then you're more likely to go out and do work so that you can pay your debts off. And again, it's the whole matrix of how this whole thing works, right? But you can see from like 2010 to 2020, unemployment was coming down. So the Fed had a lot of reasons to kind of keep rates low. And then what happened? We had the pandemic. So then they had to stimulate the economy even more. They dropped interest rates to zero again. I think in somewhere in this time, like in 2018 to 2019, they started to raise rates a little bit to kind of say, well, employment's doing good, inflation is tamed, and when this happened, COVID happened, they dropped it all the way to zero, right? And you can see that since August of 2022, we've actually seen an uptrend of unemployment, right? And this is probably due to slower economy. It's not like it was in 2020, and heck, not like it was in, I don't know what other periods of time, but it's harder to get a job nowadays, and you could see like unemployment has been trending up, and obviously this probably is going to continue as AI causes more displacement, right? Now you have less opportunity for work because there's so much that AI is doing, right? Like even the everyday plumber or technician or just very basic tasks. Like I don't really have to call my plumber to figure out how to fix my toilet. I might be able to just prompt ChatGPT a little bit and fix it myself, So like there's just going to be like a natural erosion of certain services that we're used to. And that's going to cause that displacement and that higher unemployment rate, right? Which the more people that are unemployed, the less people that spend, the slower the economy kind of operates. And we're kind of in this catch-22 where if AI does replace everything, then there's no money that anybody's making. So there's no economy, nobody's buying shoes, clothes, collectibles, nothing, right? And it's a whole other conversation. But we have seen kind of a trend up of unemployment. And you could see the manufacturing sector for quite some time now, ever since 2022, again, when the Federal Reserve started to raise interest rates and make money more expensive, the manufacturing sector has seen a slowdown. It's contracting. It's not as it was in 2020 and 2021. In this period, there were all sorts of programs like PPP and programs that, if you were a business owner and you had employees, you could get money to, pay those employees and stimulate your business in a sense. And you can see that there was like lots of expansion. And again, we've covered this already. These periods are great for crypto, specifically the cryptos that make us outsized returns, right? Like that get rich quick phenomenon. They all occur in this kind of phase of the market. We saw the same thing in 2017 as well. Like when this is rising, right? That was Bitcoin's like move to 20,000 when it made a bunch of headlines and whatnot. And then it started contracting again because things ebb and flow, right? And since 2022, we haven't really seen an expansion in the manufacturing sector. Now we might see an expansion if interest rates can be lowered. And I think that with the current administration's plan, they are very focused on, the manufacturing and bringing a lot of that back to the US. So I do think that it's a longer term play that would eventually lead to kind of another boom of the US economy potentially, right? If that comes with jobs, which it might or it might not because of AI, but that's a different conversation. But you can see that this is still kind of contracting and stuff. And yeah, and basically every month these reports come out, like they have, unemployment that comes out, unemployment claims, right? You could see that for July, right? Unemployment claims came in lower than expected. So the market would take this as a bad sign because they're like, darn it, unemployment is less than we expected. So Jerome Powell has more of a reason to keep rates higher, right? But what happened last Friday was there was a revision, and we're starting to see kind of a crack in the system of, oh, snap, like maybe it's not doing as good as we thought, right? Now, to the credit of the BIS or the Bureau of Labor Statistics, the BLS, right? They do these revisions all the time because they make estimates and guesstimates that, hey, this is, during the summer, teachers are not going to be in, they're not going to work, and we have to take that as a factor. And they kind of have these guesses that they make based on seasonality. And then as time goes on, more data comes to them, and then they make these revisions. Like, it's actually, this wasn't like the first revision that they've ever done. They do these revisions often. It was just something that was a surprise to the market, right? Now, basically, right, this was not a good thing, and the market immediately sold off. But then it was like, whoa, wait, right? So if the economy is weaker than we thought, then that means that Jerome Powell is likely to actually lower rates more than we thought, right? So then what came was, where is the, let's do poly market rate cuts. I'll just show you really quick. Fed decision in September. And you can see right now that the betting market, which usually gets things right like 99% of the time, is expecting a 25 basis point cut, right? Where originally we weren't expecting anything. And it was expecting, it's expecting more rate cuts now as well. So now you could look at this one, how many Fed rate cuts in 2025, and we have 2 rate cuts that we're pricing in. This wasn't what we originally had in mind, right? So basically the market is saying, oh, wait, actually, we're going to have more rate cuts because the economy is not doing as hot as we thought it was. And that means that we should probably buy some assets, right? Because Jerome Powell is going to lower rates, and we're a market, so we like to price things into the future, and this is the kind of future that we expect. So, you know what I mean? This is going to be a good time to kind of buy assets, right? Now you can see right here, the Fed decision in December, there's a 60% chance that they do another 25 basis point cut, right? Now, in between now and September, there's going to be inflation data. So that's going to bake into this expectation. There's also going to be more economic data that comes into December, right? Because they're going to meet in September. And I think that the next time they meet is either in November or December, because it's like every 45 days. So I'm not exactly sure the dates of the meetings or anything, but you can see that we're pricing in a rate cut for December and a rate cut for September, right? So these are like kind of good things, right? And there's also a lot of other stuff like Bitcoin cyclical movements around its halvings, right? Because the last 2 cycles, if you guys look at this chart, this is kind of me moving into a little bit of a different conversation. But, Bitcoin used to always kind of work on this pattern where, you have your halving event. Usually Bitcoin would have bottomed 500 days before the halving event. And the halving event, for anybody that doesn't know, is just something that is programmed in the Bitcoin that after it mines a certain amount of blocks, that the amount of rewards that are given to you is cut in half. And when miners solve these blocks, that's how you mine Bitcoin. So like, in the initial phases, in this phase, you might have gotten 16 Bitcoin for every block. And then after the halving, you would have gotten 8. And then after the next halving, you would have gotten 4. And then after the next one, 2. And that's how it's disinflationary, and it lowers in inflation until it reaches 21 million coins, right? But essentially there was, you could have literally, this was as easy as it was, and nothing's easy, right? But in hindsight, it was as easy as, hey, just buy 500 days before the halving and then sell 500 days after the halving. And then again, buy 500 days before the halving and then sell 500 days after the halving. Buy 500 days before the halving, sell 500 days after the halving. That halving event is going to put us, or this 500 days after is going to put us somewhere in September or October of this year. So a lot of people that follow these cycles, we call them cycle traders, right, are still expecting Bitcoin to sell off in September or October based on what happened in the past, right? Now, I personally don't believe that that's going to be the top of the market because we have a lot of other factors at play. This is not your retail-driven bull market anymore, right? All of this was happening when the supply and demand shock of these halving events actually kind of mattered, but at this point, it's too minuscule. And I don't know what's going to happen, but when you have the entire world look at the cycles of Bitcoin and be like, oh, wait, so it's going to top out 500 days after the halving, right? Usually when the whole herd is going one way, that's not the way that pays off, right? Usually when the wherever the majority is, that's where the slaughterhouse is as well, right? So you have to keep that in mind as well. But right now you kind of have certain people and certain big investors and Bitcoin, traders and, longer term investors like planning to sell their stack like sometime in September and October, which could it could cause volatility. There probably are going to be a bunch of sellers. There's probably going to be a lot of people trying to short the market and bet against it because they think it's as easy as, oh, I'm just going to, sell all my crypto in September and October and I'll just buy it 500 days before the next halving. But will they be able to buy it lower than it is in September and October? That's the bigger question, right? And right now we have a lot of players involved that are not your typical retail-driven characters, right? So like this is potentially a risk, but something that's happened already several times. You could see once, twice, right? I don't think it is likely that it's going to happen a third time. I think we'll see something a little different, right? And now we have, like you could see this chart right here. This is your long-term holders supply and price. So essentially what it's looking at is this blue histogram are the long-term holders of Bitcoin, right? And long-term holders of Bitcoin are people that have bought and held and not sold Bitcoin for years, like 5 or 7 years or something. They don't really specify what the variable is. But essentially you could see like, when the price of Bitcoin was rising in 2023 into 2024, right? The long-term holders were also rising. And then when the long-term holders sell off a bunch of their Bitcoin, right? Then we saw the next consolidation phase of the market. And then the long-term holders increased their supply and we saw a pump in price. They decreased their supply. We saw Bitcoin fall because now you have more sellers. And you could see that recently we've seen this tick all the way up. So usually what happens, right, this is that opposing force that is kind of giving us some hope maybe, is that our long-term holders have gone up since April, right? Like at the bottom of the market sometimes is also where you have the most amount of panic and fear and people selling. And we probably had a lot of that. And so after that point, it kind of starts turning around. But we have a lot of long-term holders. Now, remember, the long-term holders that are in the space right now are corporates and institutions and people that are not your average Joe, right? They're not just sitting at home and logging onto their Robinhood and buying and selling stocks and crypto and, whatever else they might be able to get their hands on. No, this is like literally billion-dollar companies who have massive treasuries and they buy these assets to hold them so that as the price of Bitcoin rises, hopefully the price of their stock also rises, right? Because now they're holding Bitcoin on their balance sheet, right? That's their asset. That's their asset. So now their price is going to be kind of mirrored to that, and institutional investors can buy that stock to get exposure to their treasury, right? So you have a lot of this right now. And this has really been the only thing I think that's been really pushing the market is all this institutional capital. You had the state of Michigan who bought like $10 million worth of Bitcoin. We literally have states inside of the United States buying Bitcoin right now to put on their state treasury, right? Like this is a massive adoption cycle that we're witnessing right now, right? And we're seeing all these big players accumulate so much Bitcoin, right? So I think that all of these new players right here are these big corporates and these people that are going to have a longer term time horizon, okay? And I can't see the chat, so I don't really see what's going on. Let me pull it up. I just want to see if anybody's got any questions or is saying anything. Do you think ETH will be the asset to blast off instead of Bitcoin after the 500 days? I think that they're both going to move together. I'll show you what I'm looking at for ETH or some really good news that has come to ETH. Before we get there, though, I got some other stuff I got to cover. I do think eventually ETH is going to give us bigger returns, but the thing is if you guys want bigger returns, you have to accept a bigger risk, right? Like in the beginning of the year, ETH fell by 50%. Bitcoin only fell by 20 to 30%, right? By 30% about, right? So if you want the higher upside, which I do think ETH long term is going to give us more upside, you just have to be okay with the volatility, right? If you're trying to find the next crypto that's going to become like Bitcoin, you're just in the red light district and you're probably not going to get out alive, right? So you got to be very careful. But I do think that what we have seen and what we are seeing right now is more appetite for risk, right? And it's starting to increase. And the thing that that's going to do then is it's going to cause the price of ETH and the price of other altcoins to effectively rise, right? And here's another piece of news that came out today on why probably the market pumped, which was Bitcoin, crypto stocks rally ahead of Trump ordering opening 401k plans to alternative assets. So Trump is about to sign an executive order that is going to allow 401ks to invest into alternative assets, right? And I've highlighted some things here. So President Trump's executive order, expected to be signed on Thursday, which is today, will direct the SEC to facilitate the use of alternative assets in 401k plans and other retirement accounts, right? Typically, most 401ks are offered a mix of stock or bond funds or index products in which to invest, right? These alternative investments, right, are a little more illiquid, right? Like real estate is an alternative investment. But check this out and look who this is coming from. Large-scale alternative asset firms, including BlackRock and KKR, have expressed support for the move, which would open up the multi-trillion-dollar retirement account industry, right? That's the biggest fund manager there is. It's not Warren Buffett and it's not Ray Dalio. It is the IRA. It is the pension fund. It is the 401k, right? And if they have now avenues to buy Bitcoin directly, to buy Ethereum directly, that probably is going to do really big things to the space, right? And they say we need to make it clear private assets are legal in retirement accounts. They're beneficial and they're becoming increasingly transparent. This is from Larry Fink, who's the CEO of the biggest asset manager in the world, which is BlackRock, the single biggest asset manager. The executive order builds on recent crypto momentum, right? And in 1 week, we had the passing of the Genius Act, which signed into law by President Trump on July 18th, establishes a regulatory framework for the use of stablecoins like Tether, right? The Genius Act is what's going to allow banks to then offer stablecoins. In them doing so, they'd be able to use the reserves that the stablecoins are backed by to buy government debt and treasuries and T-bills. That's going to lower the interest rate. The Clarity Act, which seeks to define regulatory oversight over cryptocurrencies. The Clarity Act is just bringing more regulation to the space, and the space needs regulation because, well, frankly, the reason why a lot of people aren't getting involved in crypto is because it just doesn't fit into any certain box, and it's very hard to regulate because nobody knows what it is. And then we also had, and this was really cool and good, is we had the Anti-CBDC Surveillance State Act, which seeks to block the Federal Reserve from establishing central bank cryptocurrencies. All of that passed in 1 week, and that was a really good week for crypto. Okay, so these are some of the things that are pushing the market higher. It's like this news, and we have an increasing, long-term holders. Corporate treasuries are buying. MicroStrategy is buying. Here's another. So I saw we had that question from Lion of the Chain about Ethereum, right? So check this out. So we have MicroStrategy, who is buying Bitcoin and putting it on their balance sheet. And now you have these other companies that are buying Ethereum and putting it on their balance sheet, right? Like BitMine is one. And now this company called SharpLink, right? They already have close to a $2 billion Ethereum treasury, and they just did a $200 million fundraise, right? So they just raised $200 million through selling their stock and issuing more stocks so they could raise the money. Those funds are going to be used to expand SharpLink's treasury, Ethereum treasury, with a target value exceeding $2 billion, right? Now, keep in mind, SharpLink is a gaming company. So why is a gaming company raising money to buy Ethereum? Right? Well, it's because they can, right? When you're a corporate company that is cash flowing and is making revenue, you can sell equity to raise capital. And what they do is they sell their equity, they raise some capital, and they take that capital and they park it in Ethereum or they park it in Bitcoin, right? Now, yes, the price of Ethereum could fall, the price of Bitcoin could fall, but they've already made the transaction. They said, hey, you're buying this stock at 20 bucks a share. That's what you're buying. Now, because we sold it to you, we're going to use that money. We're going to buy ETH, right? They're just building their treasury. Now, what happens is if the price of Ethereum starts going up, well, SharpLink's stock price is probably going to go up even more, right? So you can see their total Ethereum holdings now amount to 521,000 ETH, making it the second largest corporate ETH holder. The first is, I think, Bitwise or BitMine. And their strategy is focused on accumulating, staking, and growing ETH per share, right? So the more that they're going to do these raises, the more Ethereum that every share is backed by, right? Every share is going to be backed by more and more ETH. So the strategy with these ETH companies is they just stack more crypto, and then they essentially give a crypto yield, right? It's a NASDAQ listed company. The raise will help SharpLink further expand its Ethereum treasury holdings, potentially reaching a total value of $2 billion. So this was a really big piece of news that pushed the market higher. What's the next thing that we have? Oh, another thing is the prediction markets have a new favorite for the next Fed chair, Christopher Waller. And this Christopher Waller, you can see here, President Donald Trump's advisors like his openness to adjust monetary policy based on forecasting rather than current data. Now, what's really interesting about this Waller guy is the way that the Fed works now is they look at data like what we started with when we were looking at all of this stuff, right? They look at all these reports that come out on a monthly basis, and then at the meeting, they react to it. They say, okay, based on employment, right, we're going to keep rates where they are. But look at what happened. Employment got revised, and now the Fed is going to have to cut in September. And now this new guy that Trump wants to appoint as the federal chair, the Federal Reserve chair, and we don't know if this is going to be the one. This is just who everybody expects right now. His stance is, oh, you know what? We're actually going to create monetary policy based on forecasting, right? We're not going to wait for the data. We're just going to forecast what we think is going to happen. So it's rather interesting, and the market was rather excited about him, right? Waller is an ideal choice for investors given his recent dovish posture, which dovish, when the Fed uses it, it means that they have expectations to loosen monetary policy. If the Fed is dovish, it means that they're going to give the market more of what it wants. And if the Fed is hawkish, It means that they're looking at contracting the economy and doing things that the market doesn't want it to do. And political independence, credibility, right? So these are great things right now. This was what came out today. The 401k stuff came out today. That's why the market took a little bit of a tick up, right? But this is just a little bit of a reminder, right? We did have bad jobs data, and it may trigger a Fed rate cut soon, right? Powell is going to regret holding rates steady. So we have this new Christopher Waller guy who's going to become the Fed chair potentially. The betting market here is giving him a 36% chance. And we have the fact that we're going to lower rates in September, right? So all of this is really good stuff. This is really, really good stuff. And long term, right? Because now we're expecting the Fed to cut rates 2 times. Well, long term, what that's going to do is all of this money, which is this is a $7 trillion market, right? The units are in millions of dollars. This is $7 trillion that is currently parked in assets that are paying, a 4% interest rate. When that interest rate starts to fall, this money will have to go and find something else to invest into. And that's where a lot of that money comes into altcoins and stuff like that. And it is setting up for the biggest opportunity of our lifetimes. Like, it's going to change a lot of people's lives if you play it right, if you do it right, if you have the right level of patience, and you're not doing things that you shouldn't be doing, which is, getting too risky when you're not supposed to be, right? Like right now the market is changing. This is not your, we're going to find a meme coin, or, we're going to find an NFT that's going to be worth gajillions of dollars, or the next Bitcoin or the next Ethereum, right? Like right now is an era in the market, I believe, that is and look at this, right? Post 2000, where right now everybody's job here and my role and mission in my community is to bring the best research that I have on what I believe is going to make the next Amazon, Google, NVIDIA, Tesla, MicroStrategy of the next decade, right? Like, what's going to be the companies that have real value, real revenue, real foundation, right? And that's the stuff that's going to get you over to the other side, okay? It's not going to be getting into these small little coins and having all sorts of hope and I believe. No, it's going to be, you need a diversified portfolio of things that are inside of AI, inside of tokenization, inside of utility and revenue, right? And that's going to come when this wall of money starts going and finding other things to invest in, because we have all the things that lowered interest rates, right? Now, that is a long-term, maybe medium-term piece of good news, right? But if you clicked on today's live stream, it was probably because, well, what is he talking about, right? Like, what don't we see coming? Why is the title of this, is the market about to get drained? Well, let's talk about it, okay? So let's talk about the market faces a $500 billion liquidity shock. Okay, and we're going to break this down and unpack it so that we can kind of understand what's going on. So you have to understand that the Treasury General Account, or TGA, will be rebuilt after the debt ceiling, draining liquidity from the Fed Reserve balances over the coming months. That was a lot of words. It might be a little confusing. So what I did was I asked trusty Google, I said, hey, what is the Treasury General Account? Because we need to understand so we learn. The TGA is essentially the U.S. government's checking account held at the Federal Reserve Bank. It's where the government deposits tax revenues and other receipts, and from which it makes payments for various obligations like salaries, interest on the national debt. That's like our biggest expense, and other government spending, right? What it is, it's a cash management tool used by the U.S. Department of the Treasury. It's held at the Federal Reserve Bank, and it receives funds from tax payments, the sale of government securities, and the sale of government securities is the sale of bonds, right? The sale of treasuries and other government receipts. It's crucial for managing the government's cash flow and ensuring the smooth functioning of government operations. Changes in the TGA can also affect, listen to this, changes in the TGA balance can also affect the broader financial system, influencing interest rates and the availability of funds. Okay, now what the heck are you even talking about? So here's like what the Fed, the Treasury, which is separate from the Fed, right? The Treasury is government and the Fed is just the Federal Reserve Central Bank, private entity, not private entity, the government. And the Treasury announces marketable borrowing estimates. During the July to September 2025 quarter, the Treasury expects, this is literally the Treasury putting out forward guidance on what they're going to do, their goals, what they want to do. They expect to borrow $1 trillion in privately held net marketable debt, assuming an end of September cash balance of $850 billion. The borrowing estimate is $453 billion higher than announced in April 2025, primarily due to the lower of beginning of quarter cash balance and projected lower net cash flows. So right now the Treasury is kind of running out of money, right? So when they kind of run out of money, what they do is they raise a bunch of debt, right? Which, remember, when they sell a lot of bonds and there's not a lot of buyers for those bonds, well, at these auctions, they have to kind of discount the bond. They're saying, okay, this is $1 million bond that's going to pay you 5% per year, but you know what? We'll sell it to you for 900,000, right? So when they do that to you, the effective interest rate might be higher, right? So a big sale of bonds is not the best thing for the bond market because it might increase interest rates if there's not enough buyers. And right now the demand is not really there, right? That's why we're doing all these things called the Genius Act and figuring out how the banks can be the buyer, right? From 2010 to 2020, the Federal Reserve was the buyer, right? It was printing money every month and just giving it to the US and then buying its shitty debt and whatnot. But essentially, the reason why I bring this up is because a significant TGA rebuild could reduce reserve balances by 400 to 500 billion, potentially pressuring market liquidity and margin availability, right? So when the Treasury has to refill its accounts, they have to kind of suck a little bit of liquidity from the system, right? They have to suck a little bit of that liquidity out of the system so they could go and park it somewhere else, right? Now, a couple of days ago, I brought this up to the community and I said, hey guys, I'm going to start building a little bit of a cash position, because I don't know what's going to come, but the past 2 times that this has happened, it was not good for the market. So it says, and this is also interesting. Unlike past TGA rebuilds, this time reverse repo balances are already low, so their offsetting liquidity effect may be limited. And again, you're like, what the heck is a repo balance? Well, trusty old Google's got us again. Okay, so what the heck is a US reverse repo balance? The US overnight reverse repurchase balance is a facility where eligible institutions can park cash with the Federal Reserve. It's currently around 98.4 billion. This figure represents a significant drop from its peak and is the lowest level since 2021. A more detailed breakdown. The reverse repo facility is a tool the Federal Reserve uses to manage short-term interest rates. It allows eligible institutions like money market funds and government-sponsored enterprises to earn interest on their cash by essentially lending it to the Fed overnight, right? The current balance is very, very low, and it's not a good thing, right? Now, the last 2 times that the Treasury had to refill its TGA, right, the market pulled from this reverse repo and they pulled cash out of it to kind of still supplement, right? Supplement the market in a way. It's kind of like a little bit of a savings account that, we could kind of tap into. Market participants should closely monitor reserve balances and liquidity indicators as these shifts could negatively impact margin and stock prices. right? So this is something that nobody is talking about because they are kind of all caught up in the hype and the expectation of lower rates, and now is the time to buy. And you know what? It could be the time to buy, right? And I'll show you some things that, again, are saying, and this is what makes this so difficult. There's always stuff that is like super positive, and there's always stuff that's super negative. This right here, the last two times that has happened, has not been great, right? It has not been great, and I'll show you two times. So this is from the Fed, St. Louis Fed, the Fred, which is just a whole bunch of economic data, right? And you could see that there were these times like from December of 2021 all the way to May of 2022 when they had to refill this general, this TGA, right? And then when they're drawing on it, when the government is spending money that's good for liquidity, right? And at this time, we had Arthur Hayes calls her bad girl Yellen, who actually just did mushrooms and did something in China. It was kind of funny. But she used to be like an ex-federal chair and stuff. But, you know, in these times when the government is drawing this account, right, they're spending money, that's great for liquidity. Bitcoin goes up and assets go up. And then these times when the balance gets low, right, when the balance gets low, well, and they have to refill it, those are not good times for the market, right? So this is from June of 2023, like to October of 2023 and April of 2024. So these times where it's having to refill its account balance, it's not great for markets, right? Now, literally the Treasury has told us that they're going to assume an end of September cash balance of 850 billion. We are at 370 billion, right? So they're going to try to raise $1 trillion. No, just wait, line of the chain. Okay, just wait, because you might actually find some good short opportunities. What I did was I just trimmed a little bit of positions in my portfolio, and I just have a nice cash position. So if the market falls, I'll have assets that go down with it, whatever. But I'll also have cash that I built up, and I was very unemotional about having a little bit, you know, that I'll go in and I'll DCA, right? Because I do think that we have very high markets coming soon. So let's see some of this stuff. Oh, this is about the federal interest rate cuts, right? And this is saying that not all first cuts are the same. So we're about to get the Federal Reserve to cut interest rates for the first time in a very long time in September. And you could see that in the past, when they've made their first cut, right, there's different kinds of cuts. There's sometimes a normal economy where they're like, all right, we'll cut interest rates, you know, things are looking good, but this is just what we want to do, right? They're cutting into normalization, right? And you could see the size of the cut and then how the S&P 500 performed after that, right? So you could see like in normalization, 12 months after, the S&P was up 8.6%, right? This was a panic, the crash of 87, size of the first cut. In 1 month, the S&P goes down by 2.5%, but 12 months, it goes up by 13.9%, okay? Normalization, it goes up by 14%, right? So usually when the Fed lowers interest rates, well, markets sometimes go much higher as well, right? What about when they cut as a result of a recession? Well, their first interest rate cut, right? What causes a recession? Job loss, unemployment. What did we just see last week? Job loss, unemployment, right? So you got these weird little funny figures that are like, what's going to happen? In a recession, the S&P 500 6 months after was down 14%. 3 months after was down 20%, right? So not a great time, but you know, a year after it was 3.5%, right? So if you're here for the long term, a lot of this in-between noise is, well, it's just that, it's just noise, right? If you're a little more tactile and dynamic, well, you might have opportunity, right? Like Lion said, maybe we can short the market. But I wouldn't be shorting the market when it's this heated. I'd rather just have a cash position and just wait to see if something happens. And that's a very small portion, of the factor. Like, I have positions that are going to ride the market higher if it continues higher, and I just have a little bit of cash in case it doesn't. You can see 2001, the Fed cuts into a recession. A year later, the market's down. In 2007, the Fed cuts into a recession. A year later, the market is way down, right? So just because the Federal Reserve is dropping interest rates does not always mean that the market is going to instantly blast higher, okay? In 2019, they cut rates into normalization, and look at that. The S&P 500 was up 8.9%. In times of panic, usually that's like the best time, right? Because as soon as the panic happens, the Fed overreacts, they drop interest rates all the way down. The markets were in a free fall. You could see the 1 month, right? So 20%, but then everything after that, the market was up, right? So again, what we kind of want to hope is that the Federal Reserve doesn't cut because of a recession, right? Because they think a recession is coming. So this interest rate cut might not be the thing that everybody thinks it might be. And here's some charts that I have for you, right? So the one that you all care about is this pink chart in the middle, which is the total market cap of crypto, right? It's essentially the price action of what the general crypto market is doing, right? Now you had these times right here, right? You could see this right here, and from November of 2021 until like April, and really after that too, when the market kind of started going in a free fall, right? In a free fall. And then the market bottomed in 2022, and it started to recover. But then this orange line, this is that TGA, that Treasury General Account. And you could see when they're refilling it, right? Well, what happened to the market? When they started to refill it, well, the market went down, and it looks like it's a small blip, right? But from April 2023 all the way to October of 2023, the market did not do that well, right? It took a short pullback, right? Now, it didn't crash, right? But look at what we have on the bottom, right? This is the reverse repo market, right? So as the market was kind of crashing, well, a lot of liquidity was being pulled from the reverse repo, which was also funding the market, right? So like we could, like, as this article right here mentioned, was it this one? No, it was this one. Unlike past TGA rebuilds, right, which this right here, this June 2023 event, this right here, this was our previous TGA rebuild. What Janet Yellen had during this time was the reverse repo market that kind of pumped a little more liquidity in the market. And right now it's just super low at $98 billion. And the last time they were rebuilding us, it was at 2 trillion, right? So big difference. So we don't have the TGA. I mean, we don't have the reverse repo flush with cash right now, so that if the Treasury starts to refill these accounts, there's going to be another place of liquidity to kind of draw from, right? So again, leading up to the September cuts, right? We have all these things that are kind of on the horizon. Now, there's also a saying, okay? There's a saying in the market, and this is the wisest saying that there ever was. And that is that the market will remain irrational longer than you can stay solvent, right? Just because we have this information does not mean that it is the reason or the market will sell off, right? Because while this is all happening, you have, companies raising hundreds of millions of dollars to buy crypto. So you have all these players that are like dumping so much cash into crypto, and they're all institutions 2 billion into Bitcoin, 200 million into Ethereum, right? Some of this stuff might not matter as much. It might not matter as much. But right now we do have a very low reverse repo balance, which this is where eligible institutions can park cash, right? Those institutions are low on cash. And that might not be good for liquidity, especially if the market starts falling, right? Because they might have to sell their assets to fund more, you know what I mean? So you do have that potential. And right now we have forward guidance that the treasury wants to refill this account. Okay, so that is a risk to the market. All right, now this is what is not a risk to the market. I don't know, let's see what happens. But you have this guy named Colin Talks Crypto. What he did was he overlaid three things: gold, the inverse Dixie, which is the dollar index. It looks at the strength of the dollar, right? And he flipped it upside down, because usually when the dollar is getting stronger, assets are being sold off. When the dollar is getting weaker, it means that, well, people are trading their dollars for assets or other currencies, and the price of assets go up, right? A weaker dollar, asset prices go up. A stronger dollar, asset prices go down. So we flip that around so that we could see that kind of correlation. And you have global liquidity, which looks at China, India, Russia, Brazil, Europe, all the nations around the world, and their liquidity. Are they printing more money? Are they issuing more money? And all three of these things are offset by 82 days. Okay, it's offset by 82 days. Now, what he is saying is that the Bitcoin move up prediction is from August 9th to August 13th. This is August 7th. And what he's looking at is this specific blip where gold, right? This is an offset. This is what happened already, but it's been so correlated to the price of Bitcoin. You could see like these charts are basically moving the same, and the orange line is Bitcoin, and all these other lines are offset by 12 weeks, right? And you could see that like global liquidity, which is in yellow, has this sharp rise, right? This has a sharp rise, which is the inverse dollar, and gold has a sharp rise. So we could potentially see a liquidity-driven blow off top, which would mean that maybe this is going to be correct, right? 500 days after, 500 days after, 500 days after, right? We could see a short to medium term top in the market. Now, I don't like rubbing my crystal ball and telling you what's going to happen, because I don't know what's going to happen. But if that does happen, you know, we could see some crazy price action, like some blow off tops, potentially. Now, I also believe that long term, with everything that's happening with the Genius Act and the Clarity Act, where was that? We looked at, I forget. Where was it? No. Oh yeah, it was down here. No, it wasn't. I lost it. Oh yeah, the 401ks, right? 401ks can now start buying Bitcoin, and we had all sorts of good regulation come out. Good, really good for the market. Long term, this is what's going to push Bitcoin to $1 million. This is what's going to push Ethereum up to $15,000. But understand that nothing moves up in a straight line, right? So since, 2023, the market has moved up much higher. It's up generally about 352% as a whole, right? And in that time, the Treasury had to refill its account, and the market kind of just went sideways and didn't really go anywhere. And it could just put a little bit of a break, right? Now we do have the risk that the reverse repo is just it's low, so we have less liquidity. So just understand that there are potential risks, but there's also opportunity that can come out of any sort of event that happens. If you see that the market crashes for whatever reason, free falls for whatever reason, right? That's why I, as a balanced investor, we already learned about the 4 quadrants, right? One of those quadrants is a cash position, right? So you're not over invested. So you have something of a reserve for yourself so that if the market does fall, well, I can dip into my cash to buy some more Bitcoin, to buy some more Ethereum, to buy some more XRP, whatever it is that, tickles your fancy. And that could be, some really good stuff. Honestly, it's a blessing. Anytime that the market crashes or falls, all it's doing is just giving you the opportunity to enter, right? And frankly, not a lot of people take that opportunity. I did in 2020 when the market fell off a cliff, right? I looked at this and I said, man, what a time to be alive. I didn't have any investment, so I didn't feel the pain of having to hold through this, but I did have a lot of cash at that time. And I said, flip it. I'm going to invest this whole thing, right? And it did really well for me. And again, I did that in a time when interest rates were low and we had a lot of stimulus. And I think, we could be approaching some environment like that. And I personally don't believe that this cycle is over in 2 months. How could it be over in 2 months if you have a whole new kind of buyer, right? You have billion-dollar corporations buying Bitcoin. Now, could it stall out like it did in 2024, like it did this year and it fell? Could it do that again? Of course, right? But the longer that Bitcoin, the longer that things are kind of sideways and funky and not really going where you might want it to go, again, it's just giving you the opportunity to buy at a more opportunistic time. Okay? So with all of that, I mean, that's pretty much all I have for you, right? I do think, and one thing that I forgot, and actually let me just show you on our own. So let's go to Bitcoin real quick, and we'll end with this. This is potentially what also could be happening, okay? So if I look at, whoops, let me move it back to the chart. Boop. So what I've done is I've recreated the liquidity indicator, and we can look at it against Bitcoin, all right? And you can kind of see, right? The blue line is global liquidity, okay? This is global liquidity and what's happening with it right now, offset by 12 weeks. You could see that there was like this dip that happened right here, and the market also had a dip. And since then, it's bottomed out and it started to kind of recover. And what's Bitcoin doing? It's kind of following the same exact pathway. And look at this, and this is now going to be my conspiracy theorist, right? That if we see this, if we see that the market does not crash from here until the September cut, and it starts to rally, and by then Bitcoin is at whatever, 130,000, 140,000, that by the time that that cut comes in, right, which is, when is the next FOMC? 16 to 17, okay, 16 to 17, so that's going to happen right around here, right? The Federal Reserve is probably going to cut interest rates, and again, if the market is rallying into it, with my experience in investing and just kind of how I've seen this play out, what I could totally see happening is, September 16th and the 17th, the Federal Reserve drops interest rates. And if the market was rallying into it and they drop interest rates, well, there could be what's called a sell the news event, right? Then the market could be like, gotcha. We already priced all this in. You suckers are late, and dump on you, okay? And you can see that after September, that's the next time that we kind of see this drop off in global liquidity, right? Because it's offset. It's the same move that we saw, right? This blue line dropped off in December, or started dropping off in December, which was very close to the market highs, right? It was very close to the market highs. That started to kind of drop and go lower. What did the market do? It still kind of went higher for a little second, but eventually it caught up to liquidity. And when liquidity bottomed, the market did too. And we're kind of like, we're on our way to the next inflection point of where liquidity might drop. And again, we might see another, 10, 20% correction in the market, which would just be interesting. It would be interesting to see that. But yeah, I mean, this is a lot of good information. I hope you guys are getting smarter and better, and you're learning a little bit of the ways of the wise. We definitely reviewed some more macroeconomics. I hope you guys are liking the macroeconomics. So it says, so should I get out of crypto and take my loss, stop the bleeding, and come back in later? What's the short answer? Ear paper. There is no short answer. That's what a lot of people are going to sell Bitcoin in September because they think that this thing is going to play out. And come on, you sell Bitcoin at 130,000, and if a year from then it's going to be 220,000, how likely are you to buy back in, right? What I'm doing personally is I think a lot of things are going to happen, right? I think that the market could have a pretty nice correction in September, right? But what I'm doing is right now, personally, I'm really just dollar cost averaging like Bitcoin, and I would feel good about that. Also, we have algorithms inside of the art community. I'll quickly show you guys, that I'm following for my personal like gauge on whether I should be invested more or invested less. So we have this algorithm called Leo, and you can see at 3 a.m. last night, it bought ETH at 3,700, and now it's up 5%. ETH is having a breakout, right? There is a breakout in ETH. There's some resistance and stuff, but in the short term, we could see a rally. We could see a rally into September. I just think that if we see a rally into September and the Fed starts to drop interest rates, that might be a sell the news event. And I'm just speculating. I don't know. I probably know my head from my ass, but I really don't know what the future holds. I can only make probabilities and assumptions. And the fact that I don't know whether it's going to go higher or whether it's going to go lower is why I do what I do in my portfolio, which is I don't sell everything. I never go one way, right? I'm never all in and I'm never all out. I just want to play around. If I think it might be a little bit worse, okay, I'll trim a little more and I'll build a little more cash position, Now the vaults with ETH, because we offer these strategies both in the way of signals and in the way of some managed options. Look, ETH, if we go through the strategy tester, in the last 5 years, with all the stuff that's happened, COVID and 2022 and the sideways period from 2023 and the sideways period from 2024, right? This algorithm did exceptionally well in that environment, right? It's still up 12,100%, okay? It was only right on 30% of the trades because it's very fast to cut its losers. So what I do is when this algorithm gets out of its trade, right, or when it's going to exit this trade, well, I'm going to trim a little more crypto from my portfolio, because if this algorithm thinks that ETH is likely to go down, right? Well, I don't want to be invested in these times when the market goes down, right? I don't want to be invested in these times that the market goes down. I don't want to be invested in these times that the market goes down. Hey, there might be a quick little, we might, and then I'll quickly get out, But that's a little bit of how I'm managing this thing. And Line of the Chain says, I need more income, lol. There has never been a better time in history to make more income. If you're not learning AI, if you're not learning just this new wave of really, there's just so many opportunities inside of AI. If I wasn't doing the ARC as intensely as I'm doing, I would be building AI companies. You know, right now there's still bunches of businesses that need websites. There's bunches of businesses that need automation, and if you can get good at that stuff and you can start offering that value, I guarantee you can increase your income. Look at what Billy Carson did. He was building people websites in the 2000s. Now you have ways to build really cool websites, and hey, that might increase your income, you know, but that's just something to think about. But yeah, I mean, what I personally like, and I'll sneak peek some of the stuff that we're going to be releasing in the community very soon. But I don't know if any of you guys here invest or trade in stocks, but we have some algorithms on stocks that we're going to be releasing soon, because stocks are tokenized now, and you can buy them inside of Kraken or Solana. I personally trade this in my Roth IRA. But like, look at MicroStrategy. This is from 2020, a 36,000% return with only a 13% drawdown. 38 trades in the last 5 years, right? Very simple execution. I love these stock algorithms because, well, there's only one time a day where I have to manage it, and that's when the market opens. I either buy it, sell it, or I do nothing and I hold it. So these algorithms are pretty cool. So we have one on MicroStrategy. We're going to be releasing one on Tesla. This is the Tesla one from 2020. And you can see they've all been modeled in such a way that they handle the volatility of that stock very well, right? This one's never fallen more than 19%, right? And again, these algorithms, they don't care what the news is, and they don't care what the tariff is. They're just buying and selling based on a system that's been coded into it, right? NVIDIA, this one's awesome. I got into this trade inside my portfolio. It's currently up, 26%. NVIDIA's at all-time highs. And these are ways that I'm personally simplifying my investment behavior, right? Like, I don't have to make as many decisions anymore because I have things telling me when I should be buying and when I should be getting out of the market. We do have managed options for people that execute it on their own, but more for crypto. When the stocks come out, at first it's going to be a signal, and then eventually we'll find some automation for it. But it's a very exciting time to be alive. And the cool thing about these algorithms is, well, it's in MicroStrategy, Tesla, NVIDIA, and then this is actually my favorite, the GBTC. So this is Grayscale Bitcoin Trust. This is an ETF that tracks and holds Bitcoin. And it's something that if you guys have a retirement vehicle like a Roth IRA, well, you could trade this inside of your Roth, and that's where I'm trading all my stocks, right? So all the profit that I'm making on my stocks is tax-free. And when I retire, which is a long time away, like 40 years from now, but by the time that I retire, I'll be able to pull all that profit tax-free, right? So like, imagine being able to buy Bitcoin from 2020, trading this algorithm. You're up 1,900% right now, and you have never lost more than 23% of your account. And you can let that compound to infinity, right? Imagine where Bitcoin's going to be 10 years from now, 20 years from now, right? So when you start thinking long term and you have certain things set up where you're not like, the whole house isn't on red or black, I've got chips in the stock market. I've got chips in crypto. I've got cash. I've got other investments. I've got gold chilling in a safe somewhere in this world, like diversified, calm, cool, collected, and just ready to accept whatever the world gives me, But I've been sharing these stock signals a little more in the community. When we release them, they might be we might start with the higher tiered members first, but we'll figure something out to give everybody the opportunity. We do offer the crypto signals to everybody inside of our community. And that's part of these Leo algorithms that trade, ETH has been the one that's been crushing it the most. But we have a really good one on Solana, which this is from 2024. It's up, 53%, and it's outperformed Solana. But the Ethereum one is mega crushing it. I mean, just from even the beginning of this year, it's up 42%. ETH is not up 42% this year, but the algorithm is. It's pretty cool. But I really don't have a lot more time here. We're 24 minutes over. So I hope you guys enjoyed this live stream. I know you guys are always ready to learn. Are we assuming that all things go as planned with Bitcoin? Maybe I need to research more. I don't know. I'm just assuming that Bitcoin is going to be $1 million 5 years from now. But I don't know. I mean, I'm personally, like, what I did, and I shared this with the community, is, and I share my moves in more detail inside of my community. Like, if I'm buying a stock, or if I'm selling a stock, or if I'm getting in a certain position, our community members are definitely getting that information. So if you guys aren't in the Coach Alpha and Insights group, you definitely want to be there so you could follow those moves. And I'm not tooting my own horn or anything, but we bought some stocks last month, like quantum computing stocks, nuclear energy stocks, because, well, energy is going to be a very big thing in the AI revolution. Quantum computing could be a really big thing one day. Those went up like 20 to 30%, But yeah, guys, I love doing these lives with y'all. I think I'm actually going to probably start my own YouTube channel, just because I've had a lot of fun here and doing these live streams. And I always have a lot that I could talk about, a lot that I could share. I'm also doing like a billion other things all the time. So it's been more challenging to harness that focus into content, but I definitely want to get a lot better with it. So hopefully, if I start my own YouTube, you guys, I'll see you in there. When I will start my own YouTube, I hope to see you there. That is a more powerful statement. All right, guys, I got to run. Thank you. Peace, blessings. I'll see you next week, I think, because Gaven's going to be flying from Russia. So let's see how the market, what evolves a week from now, and next week we'll see each other again. All right. Peace.